We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Chris Irons, host of the Quoth The Raven podcast and author of QTR's Fringe Finance Substack. How are you today, Chris?
Good, Tom. What's going on, buddy?
Not much. Well, not much, and yet everything all in the same breath. It seems like, before we hit record here, I was saying, is there anything specific you want to talk about? But there's so many different things we can touch on. But maybe we should start by talking about obviously the biggest news over the last week, the FTX and crypto saga.
Sure.
As more and more comes out about this, seems to be, more relationships within the political and regulatory systems, possible effects on the rest of the market and other entities that might be reliant on their reserves. So let's start there and we can kind of take that in any direction that you want.
Well, look, most of what I've seen about FTX's political connections, and I see people are tying together Bankman-Fried and Ellison's parents with Gary Gensler and MIT. I mean, to the best of what I can read about that thus far, most of those connections are just, anecdotal. I mean, they're there. I'm sure these people know each other, but I haven't seen any evidence of collusion or that, one person was helping the other person kind of avoid regulation or something nefarious. Now, whether or not that comes out in the future, that remains to be seen, but I haven't seen anything like that thus far. I think the bigger, broader point here is that this thing blew up. I was doing a podcast on my own podcast last week, just talking about how wild it is that this guy Bankman-Fried was the savior of the industry. He was the guy like a week ago, Tom, not long ago, right? A week ago, this guy was on the front of magazine covers. He was the guy that was providing liquidity to these other exchanges that had failed. And he was just generally being praised and held up as the guy that was doing something different, that was, taking the responsible route, that was, really going to clean up crypto, right? Kevin O'Leary, Mr. Wonderful, said, in terms of compliance, nobody beats FTX. And what we found out was that it was just another straight up Ponzi scheme fraud, which is just incredible. So I'm often saying to people when I talk about equity markets that, everything is fine until it isn't, until one day you wake up and something is different. And that is my stance right now on equities. I think we have a 400 basis point pipe bomb making its way through the plumbing of the economy right now. And it will burst at any second. And one day we're going to wake up and everybody's heads are going to be sewn to the carpet and the market's going to be down 5%, pre-market, 6% pre-market. And that's going to kick off some panic like we haven't seen so far this cycle. Now, that doesn't happen, with advance notice. It happens like you get up to make your coffee one morning and all of a sudden you go check the futures. And for some reason, maybe, or no reason at all, something has catalyzed the shift in psychology. And that's exactly what has happened here with Bankman-Fried, right? We woke up one day and the guy who was supposed to be the end-all be-all for crypto has turned out to be nothing more than just a run-of-the-mill fraudster. And it's not just like the yield farming operation blew up or something like that. They were moving client money. They were making all these insane kind of trades. I mean, Bankman-Fried was betting on Trump to lose the presidency as one of the company's investments. He had his hand in like 100 different VC companies. It was just a bunch of kids, playing with $11 billion or however much in customer deposits, like they were playing League of Legends or something, like they were playing World of Warcraft, and so I don't really know if the reality has sunk in for them as to how big of a deal this is. and how massive of a scheme it is that they've perpetrated. I'm sure they're starting to get it a little bit more now, and I'm sure they'll have plenty of time to think about it in the future. But behind the scenes, what was going on? You had this group of kids basically just fucking around with customer deposits. And I mean, that's just bona fide, run of the mill fraud. I mean, it's not fraud on the blockchain. It's not decentralized fraud. It's just, and the fact that anybody is surprised, to be honest with you, the fact that I was even surprised is surprising to me. Because in June, on my blog, I had written an article about some of the statements Bankman-Fried made over the summer on the Bloomberg Odd Lots podcast, where he described yield farming and basically was openly describing a Ponzi scheme, so much so that Bloomberg's Matt Levine said to him, "It sounds a lot like you're in the Ponzi business and business is good." And, on top of that, the last two times that we talked, the first time was prior to Celsius blowing up. The beginning of, I think it was spring of this year, we spoke. And I said, look, this yield farming stuff is unsustainable. Mm-hmm. And then Celsius blew up. And then we talked again. And then, I made the statement again that there's going to be other operations that are going to blow up as well. And so now what remains to be seen is how much contagion there is from this whole FTX fiasco. And the baffling thing is just, what do you have here? You have an asset class that is made up of nothing but psychology. There's no cash flow stream. There's no real, I know that there's some Bitcoin bulls that listen to this podcast, I'm sure, but there's no real tangible demand or product or service. I understand the Lightning Network is a service that may have some value. I understand that the Bitcoin network may have some value, but it's not like a company where if the price goes low enough, there's a cash flow stream to fall back on or tangible book value to fall back on where, Tom, if Apple went to $5 a share tomorrow, somebody would come in and pay 10 for the company and say, hey, we're taking it out at 100% premium because it's well worth the sum of its future cash flows. With Bitcoin, there's nothing. There's a bunch of dorks doing technical analysis. Okay. And there's nothing that makes it a buy at 7,500 that isn't there at 5,000 or at 10,000. And so it exists in this weird kind of gray area. So you have yield farming, which was a Ponzi kind of spin on an asset class that doesn't really have any foundation to it, is brand new, is barely a decade old, hasn't been time tested, doesn't seem to have much of a track record, nor is there like significant demand for it right now that, we need it to go about our daily lives. And so it's going to be implosion on top of implosion, and all the while as the industry was kind of permutating over the last few years, and as Bitcoin was going up in price, which was a product of abusive and negligent monetary policy decisions, because crypto was in essence a blow-off valve for all the extra liquidity in the system. As the price rose, it encouraged people to continue to speculate. So speculating on the asset class wasn't enough, Tom. Then they had to speculate with yield farming. And that's what led to guys like Alex Mashinsky making statements that, Bitcoin pays a yield or that gold has no value, things that when you just look at them on their face, you just say, wow, this has gone horribly, horribly askew here. And so the fact that I was surprised when Bankman-Fried blew up gives you an idea of what his standing was in, the public discourse. He was the guy that was going to clean it up, right? Like he was the savior. He was the guy that, was investing in Robinhood. And I owned Robinhood stock. And when he bought some of it, I was like, oh, this is great. Like he's going to merge the two platforms. I knew there was shady shit going on in crypto, but I never thought that he would blow up like this. And I think it portends, many forthcoming blowups in the space. And I think that will create contagion in equities and in the market as well. And oh man, it's just a big mess. And every day we get another headline that makes it look worse. Like first it was just like, okay.
See, it's almost like we get 5 more headlines every day that makes it worse, not just one.
The deception right up until the end was stunning, right? So like if you wanted to try to give this guy the benefit of the doubt and say, all right, well, maybe he just accidentally misallocated some assets, or maybe he was, the victim of Bitcoin plunging. This dude was just straight up lying on his Twitter over the last couple of weeks. I mean, he just straight up came out and said assets were fine when they weren't. I mean, he's in there deleting these tweets now, but just straight up like trying to cover his tracks. And that's where they're going to get him criminally, because he has made a number of incriminating statements over the last 2 weeks that stand at odds with what the truth and the reality of the situation is. So it goes from this thing of like, oh, hey, look, we're in kind of a liquidity crunch, and we got a lot of withdrawals at once, and we're kind of on our back foot here, to we're shuffling customer deposits to cover our trading losses elsewhere and just straight up gambling. And then all of a sudden, oh, we got hacked and $600 million is missing. And now these other exchanges are moving around hundreds of millions of dollars in assets while trying to provide snapshots of their liquidity positions. And so you really have what I called a royal fuck deluxe on toasted rye on my Twitter yesterday. I mean, it is a shit sandwich of epic proportions right now in crypto. All the while, we're seeing a little rotation trade here, I think, from crypto into gold. We can talk about that later if you want. But yeah, the state of crypto it's ugly. And I think, look, if you're going to be a Bitcoin maxi, right? Because I get the case that FTX is not Bitcoin and Bitcoin is not crypto exchanges. I get that point, right? Bitcoin is something different. This is why you want to have your own Bitcoin. You don't want to leave it to an exchange. I understand that whole argument. I think Bitcoin is going to have to endure more pain. And I think that I think the buying opportunity in crypto, and I bought a little Bitcoin here over the last couple of days, and I'll probably buy a little bit more. I just buy it incrementally in very, very small bits. I'm not a huge crypto bull at all, but I think the risk reward is asymmetric enough where, to have a very, very, very couple basis points of your net worth in it may be worth it. But I think, I think the next guy that's got to go now is Saylor. I think everybody knows where his pressure points are. And I think Saylor might be the next blow up, but we'll have to see. Like I said to you last time we talked, markets have a way of kind of making these things happen when people know where your margin call point is, where your pressure point is. So it has been a stunning, stunning blow up, even for somebody that was extremely skeptical of this guy to begin with. It's still, it's 5 or 6 days later now, and I still can't believe how big of a blow up it is. It's the biggest news to ever happen in crypto.
Yeah, absolutely. And, I was wondering if this, let's say, makes an argument against that underlying technology that is Bitcoin, but obviously you're still interested enough in it to put, a couple bucks in it here or there. And is that simply because maybe not necessarily that you wholeheartedly believe in it, but just more so that you don't want to be, let's say, religious about any particular asset class and want to be able to have exposure to something that is still, an interesting and hopefully, let's say, decentralized and interesting technology?
Well, I'm pretty religious about gold. I think gold's going to be the answer come hell or high water here for this looming global economic mess that is on its way and is already kind of taking place. Bitcoin, I'm interested probably more so right now as just a contrarian, watching a huge blow up like this and then watching it cast such a negative light on crypto in general is something that piques my interest. I think I understand crypto very well. I think 95% of the coins out there will have no use case, to the extent that Bitcoin remains the granddaddy of them and the underlying of sorts as the asset class continues to bludgeon its way forward. I find that somewhat interesting. I'm more willing to listen to the bull case now, or as I said on my podcast, in the future, right? When The Economist or Barron's or Forbes, instead of putting Sam Bankman-Fried on the cover, is doing a cover story on how crypto is the biggest fraud of our generation, right?
Mm-hmm.
And I'd be like a little bit more interested in listening to the bull case once everybody else is on the other side. But really, it's just pure speculation. I'm fine with taking 100% loss. To some degree, I expect to take 100% loss. I'm okay with that. I just don't want to, I don't want to see it go to 500,000 or 700,000 and not have an investment in it. As far as whether or not it's going to become a global reserve currency or something like that, I'm still very skeptical of that. And I think the environment now is going to be conducive to far more regulation, which everybody told me would never happen and couldn't happen, which a lot of Bitcoin maxis kind of celebrate. They welcome regulation. They want to clean up the space. They want to legitimize it. But I think this is going to be, this is the canary in the coal mine for what's coming in terms of regulation, because, I listened to Gary Gensler talk about the asset class, and he has a little bit of trouble describing, how it should be properly regulated. And now I think there's going to be a comprehensive framework that's put in place to try to stop something like this from ever happening again. And we'll have to see what type of an impact that has. I think either way, I think we're going to see more blowups. And I think that this stablecoin thing with Tether is going to have to be addressed. How do you let Tether go forward now without producing a full and complete audit of all of their assets at this point? This is a company with $60 billion worth of stable coins that is deeply intertwined into the crypto universe, that has been providing these kind of lackadaisical attestations, claiming that all of its tethers that it has issued over the last few years have been backed by $1. Initially, Tether was supposed to be one tether to $1. Then it became, one tether to $1 or dollar equivalent, something backed, basically like an investment or things of that nature that would be $1 equivalent. And then a lot of scrutiny has been cast on Tether by people claiming that they don't have the backing that they claim that they have. And the company has failed to produce a truly comprehensive audit of their holdings. They produce these attestations that kind of show what asset class their holdings are in. So they'll say, all right, well, we have X amount in treasuries, we have X amount in commercial paper, we have X amount in cash, but they don't lay out the actual commercial paper that they have. So nobody can see how it's marked, right? Whether it's marked properly versus what it's worth. And they don't have a full audit signed off by a big four auditor. And I don't know how anybody lets them go one step further without providing that, because Tether could be an even bigger problem than FTX if they don't get out to the market and assure people that they have what they say they have, which many people, including myself, are very skeptical of. So we've crossed FTX and Celsius off the list. Tom, also, 3 Arrows and Voyager, still on the list of blowups or potential blowups, which may happen, right? You got Michael Saylor, you got Binance, right? And CZ here, who's the guy that kind of shook all this shit up to begin with. And maybe you have Tether, some of the other stable coins too. There's still so much excess in this asset class. Like if you just look at, Dogecoin and Shiba Inu and, Litecoin and Ripple, I mean, you're talking about billions and billions and billions of dollars that are probably all going to be worth nothing, or probably are worth nothing, but still have a value to them. So people that say, okay, crypto's come from 3 trillion to 800 billion, and so the excess is out of the system, I would argue that, that 800 billion probably belongs much, much, much lower. It wouldn't surprise me if 90% of that wound up vaporizing into thin air also. So it's going to be an interesting story to follow. That's for certain.
Yeah, it is. And it, again, as you describe crypto being this release valve for a lot of the money printing that we saw. Obviously we're speaking here on the morning of November 14th, Monday, November 14th. And yesterday, Fed official Christopher Waller said that policymakers have a ways to go before ending interest rate hikes. So, looking at this from the market perspective, do you think that the markets last week reacted maybe too optimistically on the hopes of a Fed pivot last week, and we're getting back to reality for the Fed's path forward yet here?
Yeah, I do. And I wrote as much in my blog. I think that if the Fed even came out tomorrow and cut 100 basis points, right? Say the Fed held an emergency meeting this week where they came out and cut 100 basis points, right? Of course, everybody in the market would wet themselves with joy and the Dow would go up probably 2,000 points. But let's just say that happened. I think even in a case where the Fed came out and cut rates tomorrow, that there would still be a looming blow up. Because as I said earlier, I think that the speed with which we've raised rates thus far, to raise rates 400 basis points in 10 months, is breakneck and stunning. And the reason that the economy or the market hasn't reacted to it yet is because there's a lag. There's a lag between raising rates and then it kind of making its way through the economic plumbing. And I think that's all playing out now and is going to continue to play out regardless of what the Fed does in December, Tom. It doesn't matter. The idea that the Fed is still going to raise rates in December, but people are throwing a party because it's going to be 25 or 50 basis points instead of 75 basis points is hilarious. Mm-hmm. I mean, I think that's absolutely hilarious because people have completely, everyone is acting as though Powell has achieved this soft landing already, right? And okay, well, first off, CPI, okay, it missed. CPI came in at 7.7%. All right. Not exactly where we want it to be, regardless of whether it's a beat or a miss. If I had told you 2 years ago that CPI would be 7.7%, you would have had a fucking heart attack, because it was that kind of number was absolutely unheard of 2 years ago. So to come out and celebrate that number as if it's some sort of resounding success is absolutely hilarious. And then to celebrate the idea that, okay, because we're going to hack 25 basis points off of December's rate hike, that somehow we have achieved the promised land. First off, real rates are still negative, right?
Yeah.
So, I mean, we're still in a very inflationary environment. We're still in an easing environment, essentially. And the market is, 30% off of its highs or something like that. So the idea that the problem's fixed and everything is over and done with, I think is hilarious. I think we have real hell to pay still in equity markets. And I think that it's going to be even crazier now because everybody expects that it's not going to happen. Everybody's starting to shift to this mindset of, okay, we've won the war against inflation. And I think that's the furthest thing from the truth. And I still think there's hell to pay. I just saw this morning, 2 weeks ago, I was talking on my podcast. I saw a note from Goldman Sachs saying, okay, the soft landing could be in play. And this morning there was another note. I think it was JP Morgan, somebody basically saying, and don't quote me on that, but somebody basically saying like, hey, the U.S. might not slip into recession. There's a chance the U.S. narrowly avoids recession. I'm just like, I don't think so. I don't think so. I don't think we're on the stable footing that people think we are right now. And I think going back to what I said at the beginning of the podcast, we're going to wake up one morning, like the Sam Bankman-Fried story, like COVID one day. One day COVID wasn't an issue. The next day we woke up and people were fist fighting each other over toilet paper. We're going to wake up one morning and it's going to be different. And we're going to realize that we overshot the mark. And then the Fed's going to do what it always does, which is too much, too late. It'll probably do like an emergency 200 basis point cut or something in like January of 2023 or December or February or whatever, whenever the hell this happens. And it's not going to stop the selling because again, the lag. And again, even 2% rates is ridiculous for the amount of debt that we have outstanding now. And then we're going to see some serious shit because, we're going to be in an environment where equities are going to fall. The Fed's going to be kind of trying to fire its bazooka again. But that's the kind of environment where precious metals are just going to rage higher, right?
Mm-hmm.
And we're not that far off from the next Fed pivot. I think it was Luke Groman I was listening to yesterday on your podcast talking about, getting to that breaking point, right, of like 5.5% or 5%, where, the world kind of starts to figure out that like we're in default. Like we can't pay the interest on our national debt. Like our tax receipts aren't anywhere near where they need to be. Like I forget what he was calling it, but basically the point where it becomes obvious to people that, we're insolvent. The nation is FTX. And at that point, like Luke said, you have the option of defaulting, or you have the option of trying to monetize it, and they'll try to monetize it. And I think that's where you see precious metals, that's where you see gold at 3,000, right? Like that's where you see big boy moves in the metals these last, this last week here,
mm-hmm.
even going up $100 an ounce in 2 sessions. It's a noticeable move higher, but I don't think we've seen anything yet. I think we will see, and I wrote an article about this, I think we will see $500 an ounce higher in gold over the course of just several days. I think we'll see our first, $150, $200 an ounce day at some point over the next 12 to 18 months. I really do. And then I think it's going to become the norm, because I think as the price of gold moves higher, then those types of moves, $100 an ounce becomes a 3% move. Or I'm sorry, percentage wise, it becomes a much smaller move than it would with gold at $1,700 an ounce.
Mm-hmm. So Chris, as we're talking about, let's say, inflation and the idea that we're quote unquote winning the war against it, being happy in some ways about this relative value coming under what the expectations were, there seems to be, let's say, more pieces on the other side of that deck, more cards that are stacked on the other side of that deck, that inflation could be a lot higher for a lot longer. If China starts to open back up, what does that start to do to commodity prices, which again, in my mind, only end up increasing the odds for higher inflation. And then if we do see a Fed pivot because they do need to turn things back around, if that, does spike demand again, that seems that it would only increase demand and prices again. So do you think that the Fed is going to, at some point, have to target a new higher level of inflation than the traditional 2%?
I think they will, but I think just by virtue of the fact that, first off, there's so many unknowns, right? So a lot depends on what happens with Russia and Ukraine, and China is basically conditioning their economy with this, zero COVID policy. Okay, like we're doing it, we're not doing it, we're doing it, we're not doing it. We have no cases, we have 1,000 cases, we're closed, we're open. They're basically conditioning their economy to just shut down and open up, like whenever the government says.
Mm-hmm.
So, Xi Jinping is over there flipping the economy on and off like a fucking light switch. And then you have this other big unknown in terms of Russia in Ukraine. Then you have, OPEC, and who knows what color their mood ring is on any given day. And then you have, Russia, China, Brazil, Saudi Arabia, and India basically peeling off the rest of the global economic system to try to start their own economic system, which is what's occurring now. So, and then you have to take into account the fact that next year's comps for inflation will be much higher, right? So it'll be a little bit harder to post a 10% CPI number next year, because you'll be going against this year's already inflated numbers versus last year's numbers,
right,
which were not as inflated. So, you put all those things into a blender and put it on high and try to pour out an answer as to what CPI is going to look like in the future and whether or not, things will be inflationary or disinflationary in the future. And I'm just not the guy to answer that question. I don't have any clarity on it that I feel like I should be opining on. I'm sure there's an answer. I'm sure somebody can give you great analysis on it, but it's not me. And I'm not going to sit here and try to pontificate about something that I don't really have the slightest idea on it. To me, it's a completely opaque, future. Inflation. I really don't know, other than what we can do, just tracking spot prices, right? And then trying to factor them into, maybe what next month's or the next 2 months CPI will look like. I mean, that can be helpful, but
the point you brought up about base effects of comparing last year's numbers to this year's numbers, we're going to get encouraging signs from
right.
just the math alone, but that doesn't mean that we're going back to a previous price level or something that is sustainable for your average person. It just means higher price levels that aren't quite growing as aggressively as they were necessarily last year, right?
Exactly. Yeah, they're prices that could still be naming people, but they just don't look as bad compared to last year, which is in essence what we're doing here, celebrating 7.7% CPI as some kind of miss, right? And just think about it this way, Tom. If I had told you 2 years ago that we would be celebrating that the NASDAQ would rally 7% on 7.7% inflation and 400 basis points of rate hikes in 10 months, you would have told me that the Dow Jones should be at 10,000 or less and that I'm insane, basically. But here we are.
Yeah, that maybe you clearly don't understand how markets work.
But just think about it, right? Like just think about how you would have reacted to that news 2 years ago. You have this, what do they call that? Like recency bias, I guess, or, because we're kind of stuck in this, we're zoomed in on what's been happening here over the last 6 months, 12 months, whatever. But if I had told you 2 years ago that this would be the situation now, or imagine in 2017 or 2018 before COVID happened, when we were just basically trying to do unlimited QE to get from 1.7% to 2% CPI, because apparently that's important. We need to have CPI at 2%. I mean, imagine if I told you that number would come in at 7.7% and rates would be at 4% and forecasted to be at 4.5% in another month.
Yeah.
And the market is celebrating that news. I mean, you would think I'm smoking some kind of shit.
Well, and that kind of goes to your point.
I mean, even when I'm high, I make points that are far more coherent than that. I've been pretty stoned and have made far more decent points and far better analysis than that. I'm sorry, go ahead.
I was just going to say, you wrote an article in the last week here talking about really the fact that we're in a new paradigm and we need to maybe realize that markets don't only go up, right? So does this mean that maybe the Santa pause or Santa Claus rally is likely off the table for this year?
It just means that if it happens, people should make sure that they have their compass out in front of them and understand that it may not be the beacon of optimism that it is in years past. Like the point of that article, it's a free article. I wrote it over the weekend. It came out this morning. It's called the Santa Pause Rally. You can link to it in the podcast description if you want. But the point of the article is basically look, we've spent the last 3 or 4 years trying to make investing, which is, a belt and suspenders business. It is a business where people can ruin themselves. It's a business that's laden with risk. It's a business that's cloaked in jargon. It takes a little bit of understanding. And we've basically dumbed it down for retail investors, or, the media has played a huge role in dumbing it down, right? We don't just talk about, Facebook or Amazon or Netflix. We talk about FANG, right? Because it's easier. It's easier to use an acronym. And we can group these 4 companies together despite the fact that they're completely different and have completely different valuations, right? Or we talk about, we have ticker symbols like YOLO, and things that people can remember. So, this goes back to the Robinhood kind of gamifying the markets thing. And the point is that, if there's one piece of nefarious kind of, what's the word I'm looking for? patronizing lingo that I hear every year. It's this idea of a Santa Claus rally, which is just another bullshit term made up by the financial media to further the Keynesian monetary policy experiment as though it is some virtuous undertaking that is never going to end poorly. And that just annoys me. It annoys me every year when I hear it, because basically it's a terminology used to tell people that it's okay for markets to do nothing but go up. And I think this year, people should take extra caution if markets do go up, into the holidays, that, we're on completely different footing now than we've ever been. The global, the global economy looks different now than it ever has. I mean, there's never been a point in history where the global economic picture looks like it does now. Where Russia and China and, South Africa and India and Saudi Arabia are getting together and hoarding gold and talking about making their own reserve currency. And the US is, in a position where rates are so high, we can't pay the interest on our national debt. And, like I said before, China can turn its economy on and off, and they happen to be where we buy everything from. And Russia happens to be one of the world's biggest energy producers, and they're at odds with everybody else. We are like on very brand new footing here. And so to revert back to the idea that everything's fine and everything will work out here, I think is doing yourself a disservice. And I think the lobotomized imbeciles in the financial media that continue to perpetuate nonsense like, the Santa Claus rally, which used to be a label, right? Now it's a reason for people to buy it. It used to be, oh, stocks are up, let's call it a Santa Claus rally. Now it's like, thrown around as a reason to buy stocks. And what is it? It's nothing. It's like in Chasing Amy, where he says it's a figment of your fucking imagination, right? It doesn't exist.
Yeah.
And, I tried to look back. There were a couple articles written, in the 70s it started because, there was some year-end buying that happened after Christmas and before New Year's. A couple of piss poor explanations of what it could have really been. But for the most part, it gets tossed around as an excuse to buy stocks, regardless of where we are with monetary policy, regardless of where we are with valuations. And that kind of stuff makes me sick. And it does a disservice to people that are amateur or novice investors. Meanwhile, what people should remember, and what I concluded in the piece that I wrote, is that, the same monetary policy experiment that the media is trying to legitimize and encourage to people that don't know any better with dumbed down terms like this is the same monetary policy that got us into the current crisis that we're in. And so rather than celebrating it and, trying to pass it off to people as some raging success by giving it a cute name around the holidays when everybody feels warm and fuzzy, I think people need to recalibrate themselves and understand that, monetary policy is why we're in this mess that we're in to begin with. Monetary policy is why we're watching Sam Bankman-Fried blow up and, take people's cash and incinerate it, right? Because the Fed sent a behavioral incentive to markets for way too long that speculation was fine and there is no risk and there is no volatility, right? And the reason we have inflation is because the money supply is up, 30% year over year last year, right? And so, they're the cause and the effect. And so, pardon me if I'm not amused when somebody takes to the financial news desk in the morning on television and is clapping their hands and is bright-eyed and bushy-tailed talking about a Santa Claus rally because the fucking S&P, which is already at a price-to-earnings ratio of 25, is up 10 points in the morning. Okay, pardon me if I can't muster the excitement necessary for that and that I don't buy that bullshit. So, look, that dumbing down of financial jargon, the dumbing down of the entire industry is what gave us, it's what gave us Jim Cramer, right? It's what gave us terms like this. So, I think they do more of a disservice than a service to honest people that are just trying to take from investing what everybody wants, which is safety and security and they want to do what's right for them and for their families. And, those are all the feelings that kind of come together around the holidays, which is why I think it's extra nefarious to label something a Santa Claus rally, because I think it kind of plays on that a little bit. Maybe I'm going down the, postmodern deconstruction line of thinking here a little bit, but I don't know. I can't help but look at it that way.
Mm-hmm. Well, Chris, as we're talking about interest rates and how they are affecting different parts of the economy, different parts of the markets, one thing that I think isn't getting as much headlines, personally, I think that as it maybe should, is the idea that this is really affecting the housing market as well. You recently had kind of a guest post from a realtor that and it blows my mind to think that, again, that paradigm of, let's say, 8 months ago, where the housing market, I know in Canada, was ridiculously hot, has all but completely turned around, and buyers are basically, all but non-existent, right? So that just continues to,
it's crazy, isn't it?
Put a hole, in a way, like in people's personal balance sheet, people's personal net worth, right?
Yeah. So the person who contributes to my blog, her name is Kira Mason. She is a Philadelphia-based realtor. I've worked with her several times. I happen to think that she's brilliant. She has only been a realtor for a couple of years, but I've had the experience of working up close with her. I really think she has a great eye on the industry. I think she has her finger on the pulse of the industry. I think she's a great writer. I just think she's brilliant. So I'm happy to have her stuff on there. But it is sobering to talk to her about the state of real estate markets, because I'm not plugged into real estate like I'm plugged into equities. I watch equities every day, but I don't really care about, real estate. I sold some property when everybody was offering, 10% over asking price, which, by the way, was not that long ago. That was like a year ago. Mortgage rates were at 2% or 3%. And it was a real seller's market. So I was like, man. And I remember having a discussion with her at the time and saying, this is the time you got to sell. And she was like, well, the buying demand is just off the charts. I'm like, well, those people are all dumb. I don't know what to tell you, to be out there, offering X amount over asking price all the time. So I want to be a seller here, and I'll be a buyer when shit hits the fan again. Well, here we are a year later, and mortgage rates are at 7%, and the market has completely changed. And so just, from talking to her about, and the thing I like about her in her posts, she has her own Substack too. It's called Greedy City Real Estate. But the thing I like about her is she tells stories about, buyers and sellers that she works with, and you really can understand the psychology behind these people and how baffled and dumbfounded many of them are about how quickly the market has changed. And some of the examples that she has given me of having, I got 20 projects on my desk a year ago, and today it's tough for me to even find one buyer or two buyers. And, buyers are kind of dropping like flies, and sellers are now lowering their asking price. So the market has undergone a dramatic shift in a very short amount of time. And that's what raising interest rates will do, Tom, right? That's the whole point of raising rates. If only we could have exercised a modicum of common sense and started to quell the euphoria of markets over the last 10 years with a steady hand. I mean, imagine if in 2015, right, when the markets were already at a fever pitch, imagine if in 2015 we had just said, okay, well, we're going to raise, 25 basis points every other Fed meeting until we get back up to 4%, come hell or high water. We would be in a very different space than we're in now. They tried to kind of do that in 2018 and 2017, where they raised 0.25% steadily at every meeting. And then in December 2018, at the first sign of the market trying to kind of puke some of it back, Steve Mnuchin flipped out and Powell caved and cut rates again. And that was a huge mistake. That was a huge mistake. And so, this is what happens when rates rise. The excess comes out of the system. The euphoria dies down. The buyers become sellers. Leverage becomes deleveraging. And I think we're still just getting started. And so I say at this point, take any rally with precaution in equities. Because if you're buying here and you're one of these rubes on television that's trying to make the case that we've bottomed, well, what do you have to believe, right? You have to believe that, okay, the bottom is here. We're at a Shiller PE of 25, and the S&P median bear market PE is still, 40% lower or 50% lower. And all of a sudden, this is some kind of bottom. 25 times earnings is a bottom, Tom. Like, the bear market's over. Meanwhile,
and nothing has fundamentally changed either, right?
Yeah, exactly. And what, like these rate hikes have all made their way through the system over the last 9 months? Give me a break. I'm telling you, mark my words, okay? And this will probably ruin my streak of good predictions that I made. But hey, we called Alex Mashinsky by name out and said he was going to blow up. That was an obvious one. I'm telling you, between some point in the next 12 months, I think we're going to see a real capitulation in equities that will force the Fed's hand. I don't think it's that far away. I do not think we are coming in for a soft landing like everybody thinks we are. I think we are still going to be in for a reckoning. And who the hell knows when and how it's going to happen and what's going to catalyze it. Maybe this Bankman-Fried, will be the straw that breaks the camel's back. Maybe there'll be more contagion over from crypto into equities, or maybe it'll be something totally different. Maybe we'll wake up tomorrow and some major corporation will turn out to be an accounting fraud, or some other major corporation will turn out to be a Ponzi scheme. But it's this kind of environment where these things reveal themselves, which is why it's so important that we have rates higher. Low rates encourage fraud, encourage borrowing. The credit markets are liquid. Everybody can kind of kick the can down the road. Even the Treasury. When rates move higher, look, you don't think Bankman-Fried was trying to secure a $10 billion or $15 billion line of credit to kind of kick the can down the road here? Of course he was somewhere. I think he was doing a funding round at $15 billion after he had just done one at $32 billion to try to raise $5 billion, probably to try to meet customer withdrawals. And what would that have done? Would it have made the company legitimate? No, but it would have allowed it to operate for, whatever, another year, another 2 years, another 3 years. Hey, man, when rates go up and credit markets lock up, the fucking music stops for a lot of these companies. And FTX is not going to be the last.
Well, Chris, it makes me wonder if the Fed is overly worried about the equity markets. Like they've kind of made it clear that inflation and employment many times are their biggest priorities. And I've had several guests say that they're going to let the equity markets do what they're going to do as long as they keep their focus and their goals in sight. So do you think, like, what possibility?
It would be the first time, wouldn't it, Tom?
Yeah, absolutely. That's that. I'm just trying to think through and figure out, what kind of causes that pivot if it isn't the equity markets, if it is more so, let's say the credit markets freezing up, or something else. So
maybe it is the credit markets. Maybe they point to a pension crisis or some shit like they did in England.
Exactly.
Right? But that doesn't mean that the underlying reason, because look, if something like that happens, equity markets are going to get porked anyways, right? So, they can call it whatever they want. They can say that they're cutting rates because, Jerome Powell can't get his hands on a grilled cheese sandwich for lunch. That doesn't matter. They can call it whatever they want. The point is, if you do have that exogenous event, if you do have credit markets seize up, right, like spreads blow out and all of a sudden, there's a huge, the gears are locked in the credit markets. Yep. Well, equity markets are going to tank on that anyways. So 6 one, half a dozen the other. But it would certainly be the first time. I think they're fine with equity markets coming down as long as the sell-off remains orderly.
Right.
Right. I think if we fell 30% over the next, 6 months or 12 months, I don't think that would do it. I think if we fall 10% in a week, it's going to change their attitude. I really do. Look, they have been beholden to the equity markets for as long as I have been involved in the world of finance, which is, 10, 15 years now. So the best of my understanding, and maybe somebody that's been around longer than I have can tell me something different, but from studying history and from living it, it sure seems like the Fed shits themselves every time equity markets move lower. And I don't expect that to change. If they weren't cowards, Tom, they would have raised rates much earlier to begin with. So the question is like, what? All of a sudden now Powell has this exceptional spine that he's going to, have his Volcker moment. He's going to break the back of inflation. Okay, let's see it. So far, so good, right? 10 months into it. Let's see it. Because real rates have to go positive at some point. And that just doesn't happen.
To declare a victory. Yeah.
Yeah, without shit hitting the fan, or to really create even a restrictive environment. I mean, you still have an easing environment when real rates are negative. So, good luck.
Yeah.
If that's what he thinks, if he thinks he's going to be able to hang in there, okay. Let's see what happens when the pressure ratchets up. Let's see what happens when a major, well-known international firm goes bust. Let's see what happens when the bond market, cracks up essentially and just goes bananas, driving rates even higher. Let's just see what happens. Let's see how he handles it. Let's see what his grace under pressure looks like when equity markets tank 10% in a week. I don't even think it'll be a week. I think when the shit hits the fan, I think it'll be one session or two sessions. We will see whatever the limit down markers are. We'll take out all those circuit breakers at some point, and we'll see what the Fed's official statement is at that point, Tom, because you and I both know it's not going to be, hey, things look fucking great. Everything's going according to plan. This is what we planned. Mass panic in sell-off.
Well, and because of these international markets blowing up, like the yen and the English gilts, that to me seems more likely, pointed to as a reason of the Fed maybe pivoting because we need to, help the rest of the world just to at least stabilize their markets. And I kind of go back and forth on that because the US in some ways has to be concerned about itself and its goals of getting inflation under control. But, as we've seen King Dollar bash everything else over the head, it really has resulted in some major volatility through some of those other markets. And I wonder what that next piece of news is going to be from the international community that is saturated in debt like that.
Yeah, well, you and I both. And, look, they can make whatever excuse they want up to pivot. The point is that they're going to pivot, so they can blame it on the English bond market. They can say that we're trying to help save the world economy. They can say that, whatever they want to say, but it's not going to matter. They're not following through on what they said they're following through on. And, does it really matter what excuse they give? Doesn't matter to me.
No,
I don't care. Everybody kind of knows it's coming. So, we'll know what the real reason is, right?
Yeah.
The real reason is that they really can't endure the pain of the situation that they've got themselves into. They're in a minefield of catch-22s right now, and just trying to, tiptoe through this minefield where every direction they walk is going to result in a terrible outcome, right? And it's almost like even if they just reversed all their policy decisions from the last 10 months, you can't do that because so many things have been set in motion now, with, for example, like Russia and China and Saudi Arabia and India kind of aligning themselves with one another economically. There's genies that can't be put back in the bottle now. So is there a key that unlocks the door here and solves all these problems? I don't think so.
There's no magic wand or painless solution. It's all going to be trade-offs.
And there's only bad news coming down the pipe, if you ask me. There's bad geopolitical news. Like, we know China's going to go into Taiwan. What do we do then? When does that happen? Right? We know that the BRIC nations are interested in creating their own SWIFT system and having their own reserve currency and transacting, commodities in other currencies than the dollar. Okay, so like what's going to happen there? We know that there's 400 basis points of rate hikes still making its way through the plumbing of the economic system here, just waiting to blow some poor soul off of a toilet somewhere. So good luck. I don't really know what else to say other than it's going to be an interesting point in history, and it's going to be, I guess, from a human psychology standpoint, interesting to observe. I think it's a terrible set of circumstances for the country. I think we have made decades of poor decisions when it comes to monetary policy, and they're all catching up to us at once. And I think the world knows that. And I think nations like China and Russia know that. I think that OPEC knows that. And I think that they want to put the screws to us instead of helping us out here. And to be honest with you, it makes sense. Like it makes sense that would be their stance at this point. So I don't know, buddy. Who needs a drink?
You need to get to your 2-drink minimum for your podcast here. Chris,
it's before noon, so we'll wait till the clock hits noon, and then we'll. Sorry, go ahead.
I was just going to say, you kind of hit on one of the last point that I just wanted to kind of go over with you. And that was the record gold buying by central banks that we saw for the third quarter.
Yeah.
However questionable or accurate that actual number might be, or if it gets revised lower or whatever, setting that aside, what do all those names that Bloomberg postulated have in common?
Well, they're all allies with one another. I think for the most part, except for, I don't know who Bloomberg put in their article, because I'm juxtaposing it with whoever Luke Groman was talking about in your podcast. But, I think Bloomberg was talking about China and talking about India and Saudi Arabia and Russia, countries that are de-dollarizing, countries that, traditionally, there's been a rumor going around for a long time that China has more gold than they're letting on. Whether or not that's the case, I don't know. I found Luke Groman's take to be very interesting in suggesting that the mystery buyer, first off, I think he's right in saying that, they didn't disclose their identity for a reason, which is obvious. I always, was under the impression like, okay, well, maybe it was one of these BRIC nations that could be on the verge of trying to put together its own, global reserve currency of sorts. But then Luke coming out and talking about names like Germany and Japan, who are allies, right? That would want to like hide that from the United States. I found to be fascinating too. So whoever it is, I think is less important than the idea that it's somebody, and it's probably not the United States. And so somebody's gearing up for, real currency or economic war. That's what that means. Right. And they're doing it by stockpiling gold.
Looking at the article here, Bloomberg called the buyers, quote unquote, mystery whales, and postulated that the mystery buyers were likely either China, Russia, Saudi Arabia, or India. And again, those are all the BRIC nations. So,
well, they're all the nations that are separating from the Western economic system, right?
Yeah, exactly. So again, watching their actions versus what they're saying, I think is a lot more important, and something that we've touched on countless times.
Of course, because if you look at, China and Russia's actions over the last decade, you could have seen, the invasion of Ukraine probably coming, right? I mean, what were they doing? They were actively like de-dollarizing over the last 10 years. There were articles written about it. It's just nobody gave a shit about it. Now all of a sudden you go back and you look at those articles and you're like, okay, well, this makes a lot of sense now. Okay, so what will be happening over the next year or two or three that we'll look back on this central bank mystery buyer and say, makes a lot of sense that it was them. Either way, it almost doesn't matter who it is. The idea is that there is a central bank out there that is aggressively stockpiling gold and doesn't want anybody to know their identity. If I just gave you that sentence there, you'd say, interesting, something's afoot.
Yeah,
right?
exactly.
And I think that's all we need to know. I think is, and as people that are gold bulls like we are, look, one of the basic points of being a gold bull for me is always that central banks held it in reserve. It's like, okay, well, why did they hold it in reserve?
And are still buying it.
Yeah, why? After all this pomp and circumstance and nonsense about, how it's not money, why do they hold it in reserve then? Well, they hold it in reserve because it's money. I mean, look at what I do and not what I say. Mm-hmm. And so, to me, this just furthers that. And I think once it becomes very clear to the rest of the world what is taking place here on the global economic stage, combined with the psychological element behind a Fed pivot, gold is off to the fucking races at some point. Mm-hmm. Just a question of when and how much, and how much can you transact in the miners before they're all made into state-run entities, right? Because that's something like we talked about, one of your other guests has talked about in the past. That's another question for another day. But when the GDX, 5 or 10 X's from here, what point does it become a question of the government is going to take control of gold miners because it's just basically become money on the global stage and they realize exactly how valuable it is. To think that they're going to let those companies remain private and let, every Tom, Dick, and Harry out there just buy fucking gold and silver bullion whenever they want after a drastic change like that on the global stage, I think is ridiculous. There's no way that'll happen, because gold and silver will be power at that point and governments want the power. So long ways down the road, maybe 10 years, 20 years, 30 years, I don't know, but something to think about.
Yeah, again, it's just we have to keep our eye on the ball here and try to make sense of all of these different market forces and happenings here. Chris, I want to thank you for helping us try to make sense of that. Your blog is excellent. I read it as much as I can here. And that's, of course, available at quoththeraven.substack.com. And your Twitter handle is at QTR Research. Of course, your podcast is available everywhere. And I find you have some excellent conversations there too that I learn a lot from.
Thanks so much, Tom. I love your podcast. I listen to every episode and I'm honored to be on it.
Thank you, Chris. It's always good to chat and we'll keep in touch here and keep on top of the pulse of things.
All right, take care.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.